Hello everyone, welcome back to another weekly analysis video with a winner circle trader. So the last couple of weeks I didn't post any videos. However, I have been posting daily analysis and weekly analysis guides and general bias, etc. on my Discord group. It's completely free. I would highly suggest for you to go into the description, click the link and join up because once again, it's completely free. And along with the daily or weekly analysis videos, I also post trade recaps, my daily bias, as well as the reasons why I would be looking to trade certain days and not trade other days, and just a lot of other value, such as what to study and so much more that I can't even think of right now. Anyways, let's get into the actual weekly analysis video. So this week, I think the bias is kind of mixed. We are at all-time highs. At all-time highs, I like to be bullish most of the time. However, at the moment, we do have a unfilled weekly fair value gap right here that eventually I would like the market I would like the market to tap into right now and then start maybe going back up. On the lower time frame, as you can see, there is liquidity being generated on both sides. And on Monday or after the market open, I would like to see one of the sides to get taken out and for price to move the opposite way. It could be taking out the highs and then going lower, or taking out the lows and then going back higher. In any case, I do expect the highs to get taken at some point. I do expect the lows to get taken at some point. And this area right here, it's a no trade zone because there are multiple draws on liquidity. And if there is an argument for price to go up as well as for price to go down, that basically is the epitome of low probability conditions. Now, at all-time highs, there are certain things you need to be aware of. First and foremost, the bias is almost always bullish. An example of this is we take out all these lows, low resistance liquidity, and as soon as we take it out, the market kind of just has a soup reaction and goes back up to all-time highs. We chop around because after expansion, what do you expect? You expect consolidation. The market comes back lower, sweeps this low, and then again, a soup reaction goes back up, retraces to 0.5, moves back lower. People think, okay, it rebalanced the highs or the range, and now it's going back down. It's probably going to dump, but it doesn't. Once again, soup reaction blasts back higher. And before it blasts back higher, it created all this low resistance liquidity to be able to blast even higher afterwards and make it easier for it to reach all-time highs once again. Now, why didn't it do so right there and right then instead of chopping around here? Well, there was NFP. So before NFP, usually you should expect consolidation because the day before, uh, institutional traders, they're not really going to be risking their money before NFP because the market could jump 200 points, it could drop 200 points. They don't know what's going to happen, and neither do we. So the day before NFP, general rule of thumb, just don't trade. Also, the day off NFP, before NFP news release, you just don't trade because you should expect consolidation. Anyways, NFP news release was bullish. There was a giant 1 minute rally gap that was respected and rebalanced and used as support to just push price and rally it higher. You shouldn't have expected it to move back down that day because it was a half day, it was a bank holiday, and there wouldn't have been enough volume for the market to push price back down in such a bullish condition. Anyways, since then, it's been chopping around, but it's not just chopping around, it's creating or generating liquidity here. It was already generating liquidity on the sell side previously, and it's continuing to do so here. So as soon as the market opens, most likely it's going to take out some of that liquidity. And then I'm not sure what's going to happen, but the ideal scenario, like I already said, is either for the highs to get taken and then to get a move back down, or the opposite. Now, on the higher time frame, What do you expect after expansion? Unless there's an immediate reversal, you should expect consolidation. So, the following week, I do not expect to be the best price action week of all time whatsoever, especially since we don't really have. Let me just show you guys. We don't have too much happening. Monday is a no news day, Tuesday is a no news day, Wednesday there's FOMC meeting minutes, but that's not the actual FOMC statement. So it's not going to be too impactful. Of course, it will be impactful for the PM session, but you can probably just trade London session and even the AM session if price action seems to be good and the candles are moving with volume, highs and lows are getting taken, etc. Thursday is probably the only ideal day to be trading, and I'd be looking to trade right after 8:35 a.m. If I have a good trade before market open, I'll just stop for the day. If it's choppy conditions before market open, I'd wait to see if the market open actually is or does present good price action. If it does, I'll take a trade. And as soon as I've taken one or two good trades, I'm done for the day. I'm not interested in the PM sessions, so this FOMC member Waller speaking doesn't really concern me too much. But be careful if you do trade PM session. Friday right now, there's not really anything happening, but of course, just always refresh. Keep checking Forex Factory or whatever news sources you use on a daily basis because Friday there could be Trump speaking, but we only hear about it or it's only listed on Thursday. So these things happen and you should be checking basically on the day off as well. But as you can see from the news throughout the week, you shouldn't be expecting too much volume during the week. So if it consolidates, I just wouldn't be surprised. However, if you see good price action, do definitely, you know, use that opportunity to make money, of course. But just don't go into the market every day expecting to trade. I think you'd be much safer off if you expected to not take a trade on Monday and just watch the market play out. And if you see something extremely obvious that you've seen 1,000 times play out, then maybe take a trade, you know? Same goes for Tuesday, Wednesday, Thursday, every day, especially at all time highs. Another thing, by the way, that you should be aware of at all time highs is the fact that, let me just show you. First of all, bad price action, highs not getting taken, lows not getting taken. I didn't trade Friday, but here's what I mean. Well, just generally, you can see that the low here did not get swept and the market just kind of reverses back up. The high here did not get swept, or the highs before that, or the low before this low, by the way, or that low, did not get swept, and the market just reverses. These are absolute garbage price conditions that you should never be trading. So, if you get caught up trying to gamble, trying to force trades during these kinds of conditions, you should absolutely be blaming yourselves and not the market. The market shows you when to trade and when not to trade, and you have to just trust that. So I think it comes with time, probably, but you need to just start trusting your gut on whether or not you are seeing something that is high probability or low probability. And if you don't know for a fact that you are seeing something that you're absolutely confident in, you should not be taking a trade, especially at all time highs. And yeah, another thing you should be looking out for or be aware of at all time highs is that the stop sizes are going to be a lot smaller than they were a few weeks ago. So, a few weeks back, I mean, it was kind of normal to see stop sizes of 50 points, 100 points. And why that matters is that you're going to be able to use a lot more contracts at all time highs. And that doesn't necessarily mean that you're risking more money. So, say you have a risk or accepted risk of $200 per trade. With 50 points, basically, you would be okay with taking two micros um, with MNQ because two micros, 50 points, that's $200. However, at all time highs, the stop size might just be 10 points. And in that case, you can actually take not two, but 10 micros and even take one mini at that point to save on commissions. And basically, what that means is even though you're taking 10 micros instead of two, you are still using the same dollar amount risk. And that's how you're supposed to be using risk, not in terms of the number of points or the number of contracts, but in terms of how much money are you putting on the table and how much are you getting in return. An easy way to calculate this is just by using the short or long tool in TradingView and just setting the amount of risk you are willing to take. And once you've set that, you just click on create limit order and it will just tell you how many contracts to use. Anyways, with that said, good luck this week. Use good risk, follow your strategies, and follow your rules. You will do extremely well.